At 2:47 a.m. Beijing time, a bombshell hit the inboxes of China's top exporters. The order was clear, effective immediately. No more US dollar transactions. By dawn, bond yields were soaring, Wall Street was reeling, and global markets were spiraling. One directive, no warning, and the financial world cracked. No tweets, no threats, just a silent surgical strike. Now, one question echoes across every trading floor. Is this how the dollar's reign ends? Not with a bang, but with strategic silence. Today, we break down the boldest move yet in China's war on the dollar and what it means for your money, your future, and the global economy. In April 2025, China's Ministry of Commerce quietly ordered over 400 state-owned and private firms to stop settling new payments in US dollars. A leak, confirmed by the South China Morning Post, called the mandate non-negotiable. A policy earthquake, not routine bookkeeping. Bloomberg reported a staggering 12.4% plunge in dollar-based trade settlements from China within 72 hours. ING analysts dubbed it Beijing's boldest move yet to institutionalize de-dollarization. But this wasn't just about currency. It was a calculated power play. The yuan's share in global trade finance has surged from 4.5% in mid-2023 to 7.6% by March 2025 per SWIFT data. This isn't organic growth, it's engineered dominance. With the digital yuan now powering bilateral energy deals, China's not just diversifying, it's aiming to redefine the game. But what does this mean for the U.S. financial system? The fallout was immediate. Within 48 hours, U.S. Treasury yields spiked, with the 10-year note jumping 38 basis points to 5.09%, a level unseen since before the 2008 crisis. J.P. Morgan reported over $212 billion in treasuries dumped in just 4 trading days, linked to sovereign wealth funds and Asian investors. The People's Bank of China had already slashed its U.S. debt holdings from $859 billion in January to $729 billion by March, per U.S. Treasury data. This wasn't a pivot, it was an acceleration. Mohamed El-Erian, Alliance's chief economic advisor, warned on CNBC that this shift could reset global borrowing costs for good. The question isn't just about markets, it's about power. Is China's silent strategy the beginning of the end for the dollar's throne? The U.S. bond market just hit turbulence not seen since March 2020. This wasn't a random glitch, it was a calculated signal. Weaponize the dollar and Beijing will treat it like a liability. But if U.S. treasuries aren't safe anymore, what is? The dollar's grip on the world has been slipping quietly for over a decade. IMF data shows global central bank reserves in USD dropped to 57.2% in Q1 2025, down from 71% in 2000. Now, the world's second largest economy pulling the plug on dollar settlements might have just tipped the scales. It's not just China. As Eswar Prasad, a former IMF official, told the Wall Street Journal, we're witnessing a deliberate decoupling not just among BRICS nations but even some G7 allies. The yuan's share in cross-border settlements hit 48% in March, surpassing the dollar for the first time in China's trade history. Meanwhile, Reuters reported Saudi Aramco's first full oil shipment to India settled in yuan on April 18th. The dollar's reserve currency status doesn't vanish with a grand exit, it erodes one transaction at a time. So what's replacing it? Sovereign wealth funds, and why should Washington be on edge? Let's hit pause. This wasn't panic, it was precision. If this is China's opening gambit, what does checkmate look like? SWIFT moves over $5 trillion daily across 11,000 institutions, but it's running on decades-old tech. Enter mBridge, co-developed by China, the United Arab Emirates, Thailand, and the BIS Innovation Hub. In March, it settled $23 million in cross-border trades, near instant, fully traceable, and beyond U.S. oversight. HSBC Asia's digital infrastructure chief, Anup Nandra, told Bloomberg that mBridge proves real-time dollar-free settlements across sovereign currencies aren't just feasible. They're here. While the U.S. debates digital currencies, China's digital yuan is already processing over $250 billion annually in domestic and cross-border transactions per PBOC data from April 2025. This isn't a concept, it's live and thriving. As Beijing builds a new financial backbone, President Trump's response is already sending shockwaves at home. His April 19th Truth Social post didn't mince words. Cut rates now or we risk total collapse. Within hours, the Fed felt the heat. But a forced rate cut isn't a lifeline, it's a pressure release. And when the stakes are this high, every move matters. The dollar index plummeted from 104.3 to 98.7 in just 5 days. the sharpest weekly drop since 2009. Goldman Sachs reports that capital outflows hit $76 billion in the third week of April alone, driven by sovereign sell-offs and corporate hedging. Here's the kicker. While lower interest rates might boost short-term lending, they're eroding confidence in the dollar's long-term stability. In the Financial Times, Mohammed Allen warned that artificially cheapening the dollar could push investors toward non-dollar assets like gold and yuan-based commodities. We're already seeing this play out in forex markets. For the first time in 40 years, the dollar lost value against the yuan, yen, and rubles simultaneously. So, if Washington's fiscal engine is overheating while Beijing rewires the global power grid, who's really in control? According to the Lowy Institute's Global Diplomacy Index and the IMF's trade data as of the first quarter of 2025, 128 countries now trade more with China than the U.S. This includes longtime U.S. allies like Germany, South Korea, Australia, the UAE, and Chile. China's export volume surged 8.9% year-over-year in the first quarter of 2025 per the U.S. Census Bureau, while U.S. exports shrank 3.2%. Bloomberg points out that China's edge isn't just volume, it's velocity. Beijing is rapidly signing bilateral free trade deals across Asia, Latin America, and the African Continental Free Trade Area. Meanwhile, the U.S. hasn't inked a major trade deal since the USMCA in 2020. As economic historian Adam Tooze writes in Foreign Policy, trade isn't just economics anymore. It's strategic alignment, and more countries are tilting east. But what happens when capital flows reverse too? The U.S. economy contracted 0.7% in the first quarter of 2025, marking 2 straight quarters of negative growth per the Commerce Department. Beneath the headlines, deeper cracks are showing. Real wages dropped 2.1% from last year, and consumer credit card defaults spiked to 3.6%, the highest since 2011, according to Experian. Small business bankruptcies jumped 18% year-over-year in April per the Wall Street Journal. Mortgage delinquencies surged 12% month-over-month, with Freddie Mac warning of potential systemic stress in its April 17th risk memo. Morgan Stanley economists now peg a 40% chance of a technical depression by year-end, not just defined by GDP but by sustained multi-sector decline. The Feds are in a bind. Raise rates and the housing market collapses, cut them and the dollar bleeds. So, what happens when monetary tools become geopolitical weapons? The ISM Manufacturing Index tanked to 44.7 in April, its lowest since the early pandemic, signaling severe contraction. U.S. export orders fell 9.3% quarter-over-quarter, and import volumes at West Coast ports, a key gauge of global trade health, plunged 27% year-over-year, according to April data from the Port of Los Angeles. The American Association of Exporters reveals that nearly 1 in 5 major U.S. manufacturing exporters has lost access to critical Chinese suppliers due to Beijing's capital payment restrictions. Boeing, once America's top exporter, faced $14.2 billion in order cancellations in the first quarter of 2025, more than double the losses from the fourth quarter of 2024 per Reuters. Meanwhile, trade credit insurers like Euler Hermes are slashing U.S. exposure limits, citing volatile non-payment risks. When the arteries of global trade clog, leadership becomes irrelevant. But here's the deeper question. Is the real damage coming from Beijing or Washington? The U.S. government's fiscal behavior is undermining the dollar's foundation. In just the first 4 months of 2025, the federal deficit has soared past $1.3 trillion, fueled by rising entitlement costs and emergency monetary measures, according to the Congressional Budget Office. At the same time, foreign central banks now hold just 38.6% of U.S. Treasury issuance, down from 44.9% in 2019, per the Treasury International Capital Report. China's retreat was no surprise, but now allies like Japan and Belgium have cut their U.S. debt holdings by 11% and 14% respectively in Q1 alone. Even Saudi Arabia has slashed its Treasury holdings to a 9-year low. As Mohammed El-Arian told Bloomberg Surveillance, confidence isn't lost overnight. It's eroded by erratic fiscal management and weaponized economic policies. The U.S. didn't just wake up to a world with fewer Treasury buyers, it pushed them away. So the question isn't whether the dollar is under attack, it's whether the U.S. is sabotaging itself. If China is strategically cutting the dollar's cord while America frays it from within, who's really steering the global financial future? As the UN gains influence, treasuries lose prestige and U.S. policies accelerate disinvestment. The next domino might not be a trade deal or currency swap, It could be a global reserve shift. If that happens, the fallout won't just hit Wall Street, it'll ripple through pensions, paychecks, and prices in every American home. But here's what no one's talking about. What if this isn't the final blow, but the setup for something even bigger? So ask yourself, is the world gearing up for a post-dollar era? Or is the US writing its own financial obituary? Thanks for watching. If you found this video insightful, give it a thumbs up, subscribe, and hit the bell for more. Check out another video on your screen.